Let's take a look at Chapter 11 homework problems. So I just have our ebook open to Chapter 11 problems. Let's start with the first one here, which is question 10. Franco owns 60% in the Delera LLC on December 31 of the current tax year. His basis is 128. Fair market value of the interest is 140. In a proportionate current distribution, the LLC distributes 30,000 cash and equipment with an adjusted basis of 5 and a fair market value of 8 to him on that date. Question is, how much is Franco's adjusted basis in the LLC after the distribution, and what is the basis of what is the amount of his basis in the equipment received? So let's go over to Excel and just work this one real quick. So his original basis was 128. Okay, that's what it was to start out. Then he received two things in the distribution. He received cash of 30, and he also received equipment, and this is the key, is we give that to him at his basis. So he's going to take a carryover basis because of the normal proportionate distribution that this is. So he's hit sum on that, and his new basis is 93. So 128 original basis, 30,000 cash, 5,000 basis of the equipment to get a new basis of 93. The second part of the question then asks, what is his basis in the equipment received? Well, he just receives the carryover basis of 5,000. So his new basis is 93. His carryover basis in the equipment is 5. Okay, for question 11, Lola owns 1/2 interest in the Lennox LLC. Her basis in the ownership interest is 22,000 at the end of the year. After accounting for the calendar year's current operations on that date, they distribute 25,000 cash to Lola in a proportionate current distribution. What amount of gain or loss should she recognize in the distribution, and what's the basis in her interest? So hopefully what you can kind of notice here is that her basis is 22 and she's receiving 25 in cash. Okay, so her basis will go down to 0 because return on basis is non-taxable. So let's just go down to 0. There's no tax consequence on that. The extra 3,000 that she receives, though, is a capital gain. So she would pay a capital gain tax on the 3,000, and then her basis in the LLC is now 0. For question 12, it says here that Pablo has 63,000 basis in his partnership interest on May 9 of the current tax year. The partnership distributes to him in a proportionate current distribution, cash at 25, cash basis receivables and inside basis of 0 and a fair market value of 16, and land with a basis and fair market value of the partnership of 80. How much is Pablo's realized and recognized gain on the distribution? And then what's his basis on receivables, land, partnership interest following the distribution? Okay, so kind of just keep in mind here, we'll go over to Excel and solve this. So it says right here, so 25,000 cash, receivables basis of 0 for market value of 16, land basis and fair market value of 8. Okay. So I'm going to take a look at all that information as we go ahead and do the calculation. So let's do this for Pablo. And so what Pablo receives is cash at 25, the receivable is 16, the land of 80. Sum those up. Oops. And we have 121,000. His basis, if you recall, was 63,000. So we'll do minus 63. And then we can add those two numbers up. And we get 58,000. So that's the realized gain, not the recognized gain. The recognized gain is 0. So just a 0. So he would not put anything in a tax return for a gain. He has a realized gain, yes, but there's no recognized gain as taxable. And it won't be taxable until he sells the property or collects on the receivable. So if you go back to the question here, when he begins to receive the receivables, that will be taxable income. If he ever sells the property, that'll be taxable income. And the key reason behind this is that the cash distributed is less than his basis. So he received 25,000 in cash, and so the key here is that is lower than his basis of 63. That's why this is a recognized gain of 0. When we go to part B, the basis in receivables, land, and partnership interest following the distribution. So what we do with this one is we take the original $63,000 of his basis. So this is part B, $63,000 basis. And then we subtract from that the cash received. And what's left over is his new basis of $38,000. And we assign that to the land. So his new basis is $38,000. It's assigned to the land. And so when that land is ever sold somewhere down the road, then he would have a capital gain and he would realize and recognize because he'd have the $38,000 basis against what the fair market value would be. Right now the fair market value is $80,000. So if he sells the land today, he would have $80,000 minus $38,000, and that would be his gain. Okay, question 13 is about Bruno. Bruno's basis in the LLC interest is $150. He receives cash of $55. A proportionate share of inventory and land in a distribution that liquidates both the LLC and his entire interest in the LLC. Inventory is a basis to the LLC of $45, fair market value of $48. Land basis is $70, fair market value is $60. How much gain or loss does he recognize, and what is the basis in his inventory and land received in the distribution? So first of all, there is no gain or loss. He's going to receive a lot of carryover basis. So there is no gain or loss at this point. He's going to take a carryover basis of $45,000 in the inventory. Okay, so he will just inherit that inventory and get a $45,000 basis. And then for the land, he'll have a substituted basis of $50. Let me show you how to get that. So this is for Bruno. Let's do this one over here. So his original basis is $150. He receives cash of $55. The inventory basis was $45, and so the net number after all that is $50,000. So that $50,000 is assigned to land. Okay, so that goes to land. Basis in land is $50. The basis in the receivable is $45. No capital gain or loss. 14 is about Magdalena. Her outside basis is $58. She receives a liquidating distribution of $15. Proportionate share inventory, having a partnership basis of $20 and a fair market value of $24. The distribution results in a liquidation of both the partnership and her interest. Part A, how much is Magdalena's basis in the inventory received? Okay, so she gets the carryover basis of $20,000 right here. And that reduces her remaining interest to $23,000. So what we do is start with her original basis of $58. Let's do this for Magdalena. We'll do this one over here, $58,000. We then subtract the cash received and the inventory basis that's carried over. Just sum those up, and we now have her new basis of $23,000. So go back to the question. For Magdalena, how much is the basis inventory? Remember that was 20, and then the new her new basis in the partnership is 23. And in this example, that is a realized loss. Okay, so loss recognized, and we're liquidating everything, right? Her partnership is being liquidated. Her interest is liquidated. The partnership itself is liquidated, and so that's a loss. So going back to the question here, basically she had a basis of 58. And she received $35,000 of value for that $58,000. You know, the partnership's gone, so there's nothing else that she'll ever receive. So she has a basis of $23,000 that's essentially written off as a capital loss. So she can both realize and recognize that. She can just take that right to a personal tax return and get the benefit of a $23,000 loss. Question 15, this is for Rice. Rice contributes non-depreciable property with an adjusted basis of $60,000 and fair market value $95 to the Montgomery Partnership in exchange for 1/2 interest in profit and capital. In the next year, when the property's fair market value is $100, the partnership distributes the property to Jarvis, the other 1/2 partner. Jarvis's basis in the partnership interest was $100,000 immediately before the distribution. which partner must recognize the gain, what's the amount recognized, and what is the effect on that partner's basis and the partnership interest, what is the effect of Jarvis's basis on the non-depreciable property received. So in your chapter, there's a 7-year rule with this. So if this happens within 7 years, there is some capital gain issues to worry about. If it happens after 7 years, we kind of throw that out the window. And the purpose here is we're trying to keep partners from evading capital gain tax, right? So we're saying that if Rice had just sold his property to Jarvis, we can easily recognize there's a $35,000 capital gain basis of 60, fair market value 95. So if Rice and Jarvis form a partnership, Rice puts the property in the partnership, and then a year later the partnership sells it to Rice, sells it to Jarvis. We're saying that that's still a capital gain. So you have to wait 7 years to free yourself of the capital gain. Okay, and obviously this is within 1 year. So it's a rule the IRS put in place to prevent people from avoiding capital gains as a way to contribute it to a partnership and have the partnership sell it to the other person that you would have just sold it to. So that's the key issue behind number 15. So Rice, you can see here is a capital gain of 35, and the situation is that Rice must recognize that $35,000 pre-contribution gain. And so he has to recognize that. That's going to go on his tax return. It also, though, does increase the basis in his property interest. So his partnership interest basis goes up by $35,000. Jarvis would also increase his basis in the property by the same amount, to 95. So both Jarvis and Rice increased their basis by $35,000. Okay, and that's the situation. So Rice will have to pay a capital gain tax on this, even though he didn't receive cash for it, the partnership did. Question 16 says 10 years ago, Dudley contributed land to the Prosperity LLC. His basis in the land was 100. The fair market value at the time of distribution is 115. This year, when the property's value was 200, the LLC distributed the property to partner Nikki. At the time, Dudley's basis in the LLC interest was 50, and Nikki's basis was 60. Assume the partnership continues in existence and has no hot assets. And if you recall from the chapter, hot assets are primarily inventory and receivables. What gain or loss is recognized as a result of this distribution of pre-contribution gain properties? Answer that one first. And the key with this one and what makes it different than question 15 is the timing. In 15, it was in a year. In 16, it was 10 years ago. So that 7-year rule has now passed. And so after 7 years, there is no pre-contribution gain anymore. So that's just waived. There's no issue there at all. So no gain or loss is recognized on the distribution. Okay. The second part of the question, what is Dudley's basis in the partnership interest following the distribution? It's still $50,000. Okay, so that didn't change. And then the third part of that question is what is the basis in the property received and distribution and her partnership interest following the distribution? So she'll take a substituted basis in the property of $60,000. So that property basis will just get assigned to her partnership basis, and then her partnership interest is reduced to $60,000. So it now goes to 0, and now she receives a basis in the property what her partnership basis was of 60. So basically, her partnership basis is 0, and we just took that 60,000 basis and assigned it to the property, which is now she owns, not the partnership anymore. So when she goes and sells the property, if she ever does, she'd compare the money received against the basis of 60 to compute capital gain or loss. Question 17, it says that Wiley is a general partner in a service providing partnership and receives cash of $145 in liquidation of his partnership interest, in which his basis was $110. The partnership owns no hot assets and continues in existence. After following all of the classification requirements, $100,000 is classified as property payment, $45,000 as a guaranteed payment. Assume that this payment is for unstated partnership goodwill. As a result of liquidation proceeds, how much will Wiley recognize as capital gain or loss and how much will be ordinary income. And so this matters because on Wiley's individual tax return, the tax rate you pay for capital gains is different than the tax rate you pay for ordinary income, and that's why this matters. So kind of just recognize, first of all, that he's going to have a loss. So his basis, and we're basically just buying him out. Okay, so the partnership itself will keep on going, and he is getting bought out. And it says here he receives cash at 145, excuse me, and basis of 110, and it has no hot assets. Excuse me. So 100,000 is the amount classified as a property payment, and 45,000 is a guaranteed payment. So what we do is we compare the $100,000 against the basis of 110, and that is a $10,000 capital loss. Okay, so compare this payment of 100,000 against the basis of 110. So we're buying him out. He's now no longer a partner. So he had basis of 110, and we gave him $100,000 for it. So he's got a capital loss that he can put on his tax return. He can recognize that as $10,000. Okay, and then separately to that, he receives a $45,000 guaranteed payment. If you can recall from previous chapters, in chapter 10 we talked about this. When a partner receives a guaranteed payment, that's kind of like just receiving wages. So that $45,000 is ordinary income. So just like a W-2 type of a wage. So he would pay his marginal tax rate, most likely something above 20% on that. So that's $45,000 ordinary income and a $10,000 capital loss. Okay, so that's how that works. I'm skipping 18, so I'll go down to 19. And this one deals with Sweeney. And Sweeney originally contributed $175 in cash for a 1/4 interest in Gilbert LLC. During the several years that Sweeney was a member of the LLC, his share of LLC's income was $90, and he withdrew $75,000 in cash. The LLC's liabilities are $80,000, of which Sweeney's share is $20. The LLC has $40,000 of hot assets, of which Sweeney's share is $10. Sweeney sells his interest to Jana for $225, with Jana also assuming Sweeney's share of the LLC's liabilities. So the question is, how much is the gain on the sale? What's the character of the gain? And how much is Jana's basis for her LLC interest? Okay. So before we can figure out the gain, we need to do a little bit of calculations here. Let me just kind of get rid of what's here, and we'll start with some new calculations. So Sweeney, let's look at Sweeney first. So his original basis was $175. Okay, that's original basis. We're going to increase that by $90,000 of income received while he owned the partnership. And then he also had $20,000 of liabilities that are now released to him. He also took $75,000 of cash distributions. Okay, so going back to the question, for Sweeney, basis of $175. While he was a member of this LLC, he had income of $90. He took out net $75 of cash, and then he also had a share of liabilities of $20,000, which is now going away. So if you are relieved of liabilities, that's treated as an increase in basis. Okay, it's something I don't have to pay anymore. That's an increase in basis. So his new basis is $210. Okay, let's take a look at Jana and see what she ends up with. So for Jana, we have to think about what she's doing. She's putting in $225. That's this cash to get into the LLC. Plus, she's now getting assigned $20,000 worth of liabilities. Okay. So I'm just going to sum that up, and I get $245. Oops, hit the wrong thing there. So he gets $245. So Sweeney's has $210, and he's selling his share to Jana for $245. So you can kind of just recognize that there's a capital gain of $35,000. Okay. Now the question then is, what is? So we know the total gain is $35,000. Okay, so going back to the question, the one thing we have to worry about is that there are hot assets, and Sweeney's share is $10,000. So this is where it gets a little bit tricky. So of the $35,000, $10,000 of that is hot assets, and so what's left over is $25,000. So basically, he's got $35,000 total gain. $10,000 of that gain is a hot asset. That's treated as ordinary income. Okay, so Sweeney would pay whatever his marginal tax rate is. It's probably mid-20s to somewhere in the 30s. If he's got a capital gain, then he would pay the capital gain tax on that. So remember, the capital gain taxes are one of three amounts. They're either 0, 15, or 20. So at the most, he'll pay 20% on the capital gain. His ordinary income, at the most, he'd pay 37. There's a really good chance that he has enough income that his ordinary tax rate is something above 20. So $35,000 gain, $10,000 is ordinary income, $25,000 is capital gain. Okay, and that was it. So that was the last question that I was going to cover. If you have questions about anything regarding Chapter 11, feel free to ask. Thank you.